Well, as we focus on developments that are taking place, they're rapid, they're evolving within the Middle East. And what we're going to see potentially with the US involvement, although now speculation is that potentially the US may not look to attack for 1 to 2 weeks, and that could see us in a bit of a holding pattern. But right now, we see very high volatility, both realised and implied, coming through in the crude markets and the energy markets more broadly, and that changes our trading environment more broadly. Now, despite that, we do still see a solid bid coming into the S&P and the Nasdaq futures at the moment. They're only 2-3% away from the all-time high. So it's not out of the question that we could get there in the next week or two as well. Now, the same can't be said for European equity markets, where the DAX looks actually pretty ugly at the moment. We talk about that going forward. And we move past central bank meetings, where we've seen the Federal Reserve, bit of a non-event. We've seen the Bank of England, the Bank of Japan, a surprise cut from the Norges Bank, a cut from the Riksbank. We've seen the Brazilian central bank raising rates to 15%, and we've seen a rate cut coming from the Swiss National Bank taking rates to 0. We've seen a little bit of a rally coming through in the US dollars. Does it have legs? Is it tradable? We'll have a look at that. We'll look at gold, we look at crypto, and we look at everything else going in these global markets. This is the trade-off. Well, hi, I'm Chris Weston, Head of Research here at Pepperstone, and I'm going to be joined in 2 seconds by Blake Morrow from Forex Analytics. As always, we're going to be looking at the technical setups that are front of mind. We're going to be looking at the flows, the movers and shakers, some of the news, and dissecting where the probabilities in this crazy world of markets are going to be. Mr. Blake Morrow, would you come into the show, my good sir? How are you going? Actually, before we go, I did just see a picture of you at the gym. I'm hoping the producer's not going to show it over the top. Mate, you are looking in shape, and I love that, mate. Well done.
Thank you very much. It's one of those things that as you have kids that drive themselves around, it frees up a little bit of extra time. And you're gonna find that out soon, Chris.
I do like a bit of running. It's good for the mental health, and it keeps me in check. It allows me to eat rubbish food and drink a fair amount of wine. But yeah, back on the weights at some stage. But it's difficult when you've got a 3, 7 and 10-year-old child to sort of navigate and drive to various sporting activities as well. So well done to you, mate. You're looking absolutely trim. I like to see that. Anyway, keeping the mind in shape, keeping the body in shape. Very, very healthy indeed. Anyway, let's go to topical thunder and crack on with the market banter. Right, Blake, we'll start with the Fed meeting. Now, it was out a day or two ago, bit of a non-event in some capacities. What I did, and obviously we talked in the synopsis there in the introduction about, this whole plethora of different central banks. So maybe you can sort of guide us to something that really did catch our eyes, because, the Norges Bank did surprise traders by cutting rates, and we did see a decent sell-off coming through in the NOK at a time when obviously people are focused on the NOK as a proxy for trading this geopolitical risk, because it's obviously very well correlated to the crude price. The Brazilian central bank for me was an interesting one. A lot of macro hedge funds have been very much in the LATAM carry trade, because we've seen low volatility in the cross-asset basis, and they've got 15% rates, very, very high real rates and volatility adjusted rates. So people have been using the US dollar as a bit of a funder to which is interesting. But when you've got very high rates, you can use the US dollar as a funder there. And dollar Brazil's been down. Dollar Mex has been an interesting one. I want to touch base on the Fed though, and maybe you can swing it back to that school of thought. But yeah, Federal Reserve, I think for me was obviously the highlight here is that their primary focus is on inflation rather than the growth and the labour market at the moment. And maybe that's misplaced. If we look at break-even rates, if we look at forward rates of expectation or true inflation, it doesn't scream to me that the market's genuinely concerned about an inflation shock to goods prices from the tariff issues. So maybe the Fed are misplaced. Maybe Trump's got something something to say here. That rates should be coming down, and we are seeing some fragility in certain parts of the labour market. Continuing claims are rising. You can go into the survey-based data, such as the consumer confidence situation, and see jobs are being seen as harder to find. And you've seen negative growth coming through in the household survey as well. But the Fed do seem to be concerned about the potential for an inflation rise, and their core PC projections by the end of the year are 3.1%. They've raised them higher. The Fed look like they're in a holding pattern. But do you think, how did you see the Fed meeting? Do you see anything actionable from this? And do you think that their view of specifically focused on inflation is somewhat misplaced?
Well, first of all, let me say that as far as Donald Trump having something to say, he did have something to say.
Yeah, of course he did.
He's still calling too late, pal, to the game. The first thing I screamed out, I happen to be, trading around the FOMC. Obviously, the first thing that I thought of was, holy stagflation. Your GDP forecasts have come down a little bit. Inflation forecasts.
Very stagflationary set of SEPs, wasn't it?
Yeah, I mean, that. So you got to think about that as far as how's the market going to take that information. I mean, everybody obviously has been jumping on all the financial media and talking about stagflationary data that's coming our way. But is the Fed misplaced as far as inflation goes? The drop-off rates of inflation that we're going to see on a year-over-year basis, all the big numbers have dropped off. So now any tick higher in inflation is actually going to make a big difference to the bottom line. And that's the one thing that I've been talking to a few other people about that. So if we see month over month inflation tick up 0.1%, maybe higher than analysts are expecting, or 0.2%, it's going to have a pretty big impact. So I think that's what the Fed is waiting for to see. But the Fed is a reactionary organization. That's what they're going to do. They're going to react. They're not anticipatory. Hang
on, I want to pull you up on that one, because they have prophesized and assumed tariffs in their forecasts. So I agree that they are traditionally a reactionary bank. I mean, they before COVID, they were all about this average inflation targeting, which was very reactionary and so slow because they were averaging it. But now that I think, do not take into consideration that there are elements of some participants are forecasting the impact of tariffs and putting that into their inflation, and that tariff impact may not come.
But let's talk about the other side. I know we probably need to move on, but let's talk about the other side of tariffs. You're talking about inflation. How about the lack of hiring and lack of purchasing from U.S. companies and businesses because of the tariff risks? I can't tell you, and this is very anecdotal.
You're saying tariffs could be disinflationary.
They could be, yeah, absolutely, yeah. And maybe the Fed should be cutting rates, but at the same time, what does that do? Disinflationary, yes, but maybe price pressures stay relatively elevated, where you start to see a tick up in inflation. You start to see corporate earnings really taper off this next quarter, and it is a balancing act, Chris. And and the Fed did a great job at giving us a nothing burger as far as volatility goes. So you want to talk about price stability? They're at least meeting one mandate for sure.
Yeah. I just think that the visibility from the cross currents are just shrouding their judgment. That they just wait. Right, we'll just wait for a bit more evidence, and then we can make a firm judgment call. But I think you make a good point here. Prices at goods will go up. They will do. But what happens to consumption? The consumption side goes down, and that will be probably the dominant factor. So, there is a view that you can get inflation going up, but there's also a view that it could actually be disinflationary, and it will be a disinflation for a lot of other countries. And so, that's something that I think the Fed will want to see that dynamic play out, and that's not going to happen overnight. So, I think it's an interesting one.
It really is, and I think it's a really interesting topic of conversation. And if you guys have any opinions, I think the comments down below is open.
Smash it.
Jump in the comments and tell us how you feel about, are we or aren't we going to feel inflationary pressures?
Do you think Trump's onto something? Do you think he should? Trump is actually, but of course we know that Trump has a vested interest in getting rates down. He wants to see the economy firing up, and that also we've seen some fragility in the house prices as well in the US, and I think that's an interesting one.
He's got phones to sell, baby. He got phones to sell. Come on. All right.
Yeah, but is he onto something? Let's see. Yeah, go on.
Let's move along to the next topic. Let's talk about the Israeli-Iranian situation, and obviously. The headlines that came out your morning or overnight. Yep. Anyway, that the Trump administration might be waiting 2 weeks, up to 2 weeks. And what we've seen is an unwind of dollar longs. The stock market has bounced, crude has pulled back, and that's the great news. And I was telling our traders in our community, the great news is we know, and we already knew anyway, but we know how the market will react if there is U.S. involvement moving forward. Now, a lot of you might go, it's taco. Trump is chickening out. I think he's playing. He's playing his cards, and the threat's there, and he's given Iran some time to really think about what they're doing. But moving forward, Chris, I wanted to get your opinion on how you feel about this conflict. I'm not a big short everything, because geopolitics, it does create a little bit of volatility. I do believe if as long as it's not affecting, well, I say the U.S. markets, and the reason why I say the U.S. markets is because globally, asset managers are so heavily invested in the U.S. equities at this point that I think it really matters. But as long as the U.S. isn't really involved, the market's not going to care a whole lot. And this situation where they might actually pause for a couple of weeks, or they might wait a couple of weeks before taking action, I think is a taco trade in a sense, where he might not be chickening out, but he's giving the market some time to digest this. So what are your thoughts about where we go from here with the Iranian and Israeli conflict? And I do have to say, just before you answer, one of the things I tell our community all the time: don't get freaked out about nuclear and that. Don't fall for all that clickbaity stuff. I mean, let's face it, we're all humans, and no one wants to get wiped off the face of the planet. I'm even the Iranian leadership. So
it's an important point. I think it's an interesting one because, the day before we were led to believe from the same Wall Street Journal article that it was imminent that the US 1 to 2. We've seen 3 of the biggest warship carriers coming over to the Middle East, and the UK had sent one as well. So there was a huge amount of personnel. The US were moving key military bases away and protecting those. And so we were like, crikey, this is all, this could be big weekend gapping risk that's going to take place, from this situation. And now we're, like you say, Trump's pushed it out 2 weeks. And that happens just as the Brent price and WTI price was moving up, through the highs that we saw. And so people went, well, he's come out of this change 33 minutes after the futures close. Why has he done that? When the price of Brent and WTI was moving up. And so maybe he was like, well, I am sensitive to the price of crude. I campaigned on getting energy prices lower. I think it's very different. This idea of taco that we saw post tariffs, where the market bossed him into that big change, I think it's very different. The crude price is high, but it's not, at levels where he's gonna have like complete dirt on his face in this situation. So I'm against that view at this point. But the situation is very fluid. They've got all these. It's a very costly exercise to send warships over to the Middle East. And honestly, I actually genuinely thought something was likely to happen. It just feels, he's got to do that to perhaps his view is to get the Iranians to the table and obviously cede their nuclear capabilities, enrichment capabilities. And that situation could change again. We've gone from 1 to 2 days to up to 2 weeks, and it could probably change again very quickly. So it's a very fickle news flow, and we're trying to get that noise and the signal situation playing through. But again, I think it's what's the Brent price telling me here, Blake? Well, $80, around $80. I think realistically, it's giving us a high probability that Iranian exports. Crude exports are going to be impacted. I think, sort of $75 to $80 on the Brent price is telling you, that's the sort of range that people say that 1.5 million barrels per day that they export is probably going to be affected. Even if we think that longer term, there's a probability that Iranian exports won't get impacted. And over time, the markets will become comfortable with what they're seeing, and then that no other neighbouring country is going to be impacted by this. And this idea of the Straits of Hormuz being impacted, obviously, very, 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 very low indeed. It's never been done. And Iran have threatened to close the Strait of Hormuz, I think, 15 different times over the last 30 or 40 years. So, we just suspect it's very, very low. Probably it's going to be a last-minute roll everything, last throw of the dice, risk it all type of strategy if they were to go down there. But I think, the market is probably already pricing an element of Iranian exports being impacted. And so that's really what matters to the oil market is that supply demand dynamic. At the moment, sort of the consensus view for next year is that the crude market's going to see about a 1.2 million barrel per day surplus, which is obviously why the futures curve is lower, and we've seen that sort of backwardation coming through. But if you take Iranian barrels out of the export barrels out of the market because they've either been impacted by their infrastructure sites have been impacted through shelling or drone attacks or whatever, or there's sanctions being placed on them, then you get a much more balanced equilibrium state supply-demand barrier, which will probably mean then OPEC looking to pick up the slack. So I think that's where we are at the moment, and it's just a moving ship. Everyone's trying to price this idea about what happens to Iranian exports. Does another neighbouring country be brought up into the mix? And that, I think that's really where the crude price is trying to work out and ascertain what that looks like.
Okay. Well, I mean, I think I want to say that, this is like the U.S. is taking all their risk pieces and putting them on the right part of the board. It might take up to 2 weeks.
Yeah. Well, I think the Wall Street Journal article also suggested that, if the US does come in and use these bunker busters to go after the Fordo enrichment plant, which is the main one everyone's talking about, right? It's the one that's half a mile underground, heavily fortified, and they need the US's bunker buster to go in and smash through the mountain, and Israel apparently don't have the capabilities to do that, so that's why they need the US. If the US was to go after that enrichment site, then Iran would either potentially smash its own infrastructure to try and raise the oil price, or actually go after neighbouring countries. And that's kind of where we are in terms of why the US, I think, is important in this situation. Anyway,
all right,
let's talk about the US dollar, mate, because look, we got euro dollar up to 116 again. It's come off those levels. That's obviously the level that people are happy to sort of sell into at the moment. Dollar yen's had a bit of a move through 145.05, which is a recent high. We saw the Bank of Japan meeting coming out, and we've got actually, probably more importantly, is the Ministry of Finance in Japan will be canvassing the primary dealers today to talk about their duration and what they're going to be issuing going forward, and that could have big implications for the JGB market and by extension the yen. But you have seen the dollar index moving up a little bit higher as euro dollars moved down, dollar yen's moved up, and while cable's still actually quite strong. But, obviously we've come up to very oversold levels. Real money accounts, very, very short of US dollars at the moment. Leverage funds have reduced their positioning of shorts. How do you see the balance of risks in the short term for the US dollar? How are you trading that broadly?
Well, I stood on a mountaintop, or I actually posted on X last week, that now I am more of dollar. I want to say I'm dollar neutral, but that's not really the case. I'm still a dollar bear. So I still want to ultimately short the dollar, but I think there's going to be two-way price action here, Chris. And that's you just pointed out that the leveraged funds are very aggressively position-wise. They're positioned short dollars. Everybody thinks I don't. You read all the bank research that I do. Everybody's targeting 120 to 125 in 2025. So,
but does that not worry you that? There's a long term. I think Morgan Stanley 125 and JP Morgan is short dollars, and Goldman Sachs same thing. But that's a longer term forecast based on this idea about a gradual lowering of the exceptionalism story, and people lifting hedging ratios and bits and pieces. But getting to 125, if we do get to those points, is obviously what we need to do as traders. We trade in and out of that view, but we don't. I don't like views because they give us a bias, but. Are we not at risk of a short-term rally in the US dollar, which we then potentially sell into?
That's my point. So as silly as it sounds, Chris, there are a lot of hedge fund managers and asset managers that really don't do anything but read bank research, and they get their biases from there and they position themselves accordingly. And as silly as it is, they don't do the backbreaking research that you and I do on a daily basis.
Let's set up a hedge fund.
What's that? I mean, we should. Sit back, take our.
We just need to find a lazy $250 million.
Right. That's all. 250. Just try 850 million. Why not?
Yeah. Well, let's small,
go big. Let's go big and just position ourselves short dollars and ride the euro to 125, because that's what a lot of people are doing. And the problem is you got everybody positioned in this direction. And yes, some of those leverage funds are coming off, but I think there is room for a consolidation. And I'm a happy buyer in the euro at 112. I just don't know if we're going to see it or not. Chris.
Yeah, well, there's the 50-day on the Dixie, which may be a level there, and 102 could be a really good level for me to sell into the dollar index. But I think the problem with holding a euro dollar long for 12 months is that you pay carry on it, and that will eat away at the gains, I guess.
Yeah, sure. Especially if you're buying at this stage in the game. So hey, let's go to the last topic, and I want to talk a little bit about metals because, well, I tell you, Chris, the rally that we've seen in gold, silver, the big breakout, and I say the big rally in gold. I mean, you can talk on it, just this year on a breakout basis. The up 30%. It's ridiculous. But the move that we've seen in platinum has been groundbreaking. It's been amazing. Copper is its own metal, but I did want to have a little bit of a discussion about metals because we're seeing so much volatility and so many traders are just trading around these levels. And so I think I still don't have a bearish argument for gold. I know there's one out there, and I know eventually gold's going to, have its day in the under the sun. No, over the sun.
In the doghouse.
It's gonna get hit at some point. But I want to get your thoughts because I'm sure so many Pepperstone traders are trading the metals quite aggressively. How are you seeing the metals market? Are we late stages in the game, or do you have to wait for a bigger pullback? Do you start positioning yourself short? What's the short argument? Go ahead, Chris.
Yeah, well, I mean, gold's every day is our top traded product of all the markets we offer, and then I'm going to the dollar pairs as well. So people love gold, and yeah, I can explain a million reasons why that's the case. But I think it's not necessarily a macro view that we've got. It's just the fact that it's a bloody good trading vehicle. It's open for long periods of the day. It's very liquid and it's cheap to trade, and I think that suits a lot of people's trading strategies. But yeah, I think the fact that we are in a few holding patterns in markets, people are questioning what the catalyst. We've been talking for the last 2 weeks. What is the big catalyst? And we've got geopolitics, and it's obviously moving the oil price. And I think what you're going to see with gold, and you have seen it, is when the rate of change intraday picks up on the crude price, gold goes along with that as well. So it does. When we see a big move coming through up and down, you do see the gold price moving in alignment with crude, but obviously at a slower pace, a lower beta, for example. And so it does have some geopolitical qualities in this situation. And I do believe as well that if I'm starting to build this thesis that this inflation view out there may be misplaced and we don't get it. And it's not going to be a problem. And maybe the Fed will be cutting rates at some stage fairly soon. September is seen as the likely date. We'll see, maybe that's about right. But, if the labour market was to kick, I think the big issue for gold would be if, like, my trigger point for where the market goes, shit, we've screwed this one up. The Fed are looking at the wrong thing. It may not have happened, but my trigger point would be weekly jobless claims going above 280,000. We're about 245 at the moment, so 280,000, and then that was married on the same month by a payrolls number which came in below 80,000. I think the market would go, shit, we're looking at the wrong thing. The Fed are looking at the wrong thing. We've just seen a really bad labour market print. And I think that could be a trigger point for a volatility shock. As I say, it might not happen, but that would be something I'll be looking.
But what does that do to metals? What does it do to
gold? I think
gold?
in gold's terms, I think that would be very positive for the gold price. Why? Because you'd see rates going down. I mean, you'd see rate cuts being priced in. You'd see real rates moving lower, and you'd see obviously a dollar shock. So, because if you look at the dollar smile theory, for me, part of the reason is we're right in the central point where, the US has been slowing down and, it's looking less good, and other places are okay and they're cutting rates to stimulate. So I think, I think if you were to see that happen, I think you see the US dollar down, people start, talking about rising recession risk and fragility in the labour market. Maybe it needs a second month to do that, but it may not happen anytime soon, but that would be a really big trigger point that I'm looking out for in the future to say, shit, the labour market's not looking great. Weekly claims above 280,000, and that would need to be married by, a weak headline payrolls number. And maybe it doesn't come, but that would be a really big trigger point for de-risking and higher volatility.
Fair enough.
Yeah. But we're already seeing continuing claims rising. Did the new jobless claims come through and that's some... Huh?
Yeah, wake me up when we get above 260. And you say 280. Fine, wake me then.
I mean, look, forget about it. I mean, the unemployment rate's at 4.1%. That's all you need to know at the moment. It's still a pretty healthy labour market. I'm not saying, I'm not a doomsmonger. I'm saying, the labour market's good. All I'm saying, Blake, is that there are trigger points which may not come, which I think I'm looking at, which I think the market would look at very, very closely if it happened.
100%.
Yeah. Mate, don't get like that just because you're all buff and trim and must.
Come on now.
All right, let's go to the technical. Let's go to that's the setup. Sorry about that. We sort of took that one along. We obviously had a lot to say. We'll try and keep this one a bit more succinct. Let's start with gold because we did talk about it just then in the metal section. But yeah, you can see we made I don't want to say triple tops. I don't believe in triple tops, but you can clearly see that we've got a bit of a fundamental ceiling in the gold price. The Chinese just couldn't kick us through that level. That's where you've seen a lot of buying. To answer your previous question, Blake, when the Chinese come in, there's been an insatiable bid from China to buy in Shanghai futures in the Chinese ETF complex. That sort of dried up. One of the things we just have seen is Citigroup came out of a note this week, which I'm sure you've seen, which they've called out a pretty bearish position on gold for next year, which caused a few people buy stock because it's an out of consensus call, which may or not come to fruition. Their logic is reasonably sound. I don't think that's really affected the gold price, to be honest. I think we're just seeing a little bit of a bid coming through in the US dollar. Real rates have moved up a touch. And also you have seen oil prices, which pushed us up into those high levels, consolidate as well. So where do I see this going? I think a lot really depends on the Brent price. If we see the Brent price holding above $80 because people are seeing a greater probability of the US being involved and potentially Iran going after a neighbouring country, which I don't think is probably a 5-10% chance at the moment. But if we were to see those probabilities move up, and the dollar rallies because of perhaps more of a safe haven flow, and we do see, calm in the real rate story, I think we'd probably trade down a little bit lower. 33.20, I think we're probably growing lower. The price action at the moment is showing we've come off a bit of the high from an overloved position. Bit of indecision. We saw that in the doji in the previous session. It doesn't really give me any major convincing trades from this higher longer term time frame daily picture. Probably if you put a gun to my head, I'd probably see some downside risk. But I want to see that doji candle. If we were to break through those lows, that would tell me that the risk of a further move down into the sort of black range lows, what's that, 32.83, would increase in probability. So that candle that we've seen, the doji candle, in the prior session, I think the range there really is important because at indecision, we need to reconcile that indecision. A break through those lows would increase the probability that we've got lower levels there. Very good. I love the good indecision doji candle. That's for sure. All right, Chris, my first setup is going to be the US dollar Japanese yen. And this is going to be your daily dirty Harry, you feeling lucky punk. And you know what I was looking for, Chris? And the thing is the dollar yen's actually come off about 50 pips since I took this image of this chart. I'm looking at a really tight consolidation, and frankly, I'm looking for a move up towards that 146.20 level. That is the 618 retracement. You can see, you can just look left, and it's a horizontal resistance level. Yeah, it's also the triangle. I'd really love to see an opportunity for us to get up there. Yeah, because I think the yen has not been looked at as a risk aversion vehicle. Not as of late. Yeah, I mean, look at the euro yen. Look at sterling yen. I mean, they're all New Zealand yen, Aussie yen. They're all pretty perky at this point. But then again, we haven't seen any real risk aversion. Yes, Israel and Iran, obviously the tussle continues. But should the U.S. enter the fray, I think the yen actually is going to reciprocate by being a little bit more bullish, which means that we will roll over in the dollar yen. We'll probably see the other yen pairs roll over if that is the case. We have this 2-week window, but it could be a week, it could be a day, it could be a couple of days, it could be this weekend. I'm just hoping that we see 146 ahead of there because I am looking to trade on the short side. We break above 146.20, then the triangle is nullified and we get an upside breakout. So I love it. Love it. I do. And we've seen on the daily chart, we can see that it's probably the risk for me is that we push higher. So I like the directional call from you. I think what's interesting here, Blake, just while I'm on a bit of a subject here is, when we see that people have looked at the probabilities and said probably, we've still got a 55-60% chance that Iranian exports aren't affected, that we will come to the table. Look, we've got a loss of life, which is terrible to see, but the markets are more concerned specifically about exports and various factors. And, we still think that there'll be a solution that comes through on nuclear longer term. we're bad at pricing risk around that because we're not military experts or geopolitical experts. But yeah, I think when we've looked at crude having a move up, you haven't really seen the VIX respond. And like you say, you haven't really seen the yen respond. And so people have probably said gold's probably your best currency in that situation to hedge. But let's have a look at that crude move because, yeah, like you say, like I said, I mean, we've seen that breakout, the consolidation. We've moved up into $76 in WTI. I've used that. Brent's probably the better one because that's obviously the global benchmark. But the WTI got into 76. And now we're just consolidating. We're seeing, the market deciding, well, we've got into a nice spot for where we think things are priced. And so I think right now you probably trade a range long and short within that situation there. But what I think is interesting, if you have a look at the bottom chart, this is the OVX, which is the oil ETF. Effectively, it's the oil VIX, which is effectively different strikes within various expiries, which blend to a 30-day implied volatility. Same calculation as the VIX index, which looks at the S&P volatility. But that's at 66% at the moment. Now, that's really important for me as a trader because what's implied over the average move over the next 30 days is about 4.1% up and down daily swings in terms of percentage moves. Now, is that for you? It doesn't matter. I mean, yeah, if you're a very short-term strategist and you can be in front of the screens, and you've got the strategy that works well in very high expected volatility markets, then these are great moves for you. But if you're someone who's working off slower time frames and slower trading strategies and have a lower risk tolerance, then when you see a market with a 66% vol, you probably wouldn't look at that. There's plenty of other markets which are lower volatility and lower ranges. So you've got to trade the market conditions that are put in front of you. And when you see the oil VIX trading at 66%, it's come a little bit off the lows, but you've got to say to yourself, is that for me? Now, it will suit a lot of strategies, I say, but right now I'm seeing consolidation playing through as the market's trying to understand, will these Iranian exports get impacted? Will a neighbour come into the fray? And what does it mean if the US does get involved? And if they don't, maybe they just come purely on a strong arm diplomatic situation. Have we got good downside coming back into these oil prices? Yeah, could Brent prices come back to where it was before we got the geopolitical risk premium priced in of 66, sort of 65, $60? So yes, Blake, you know what we do in trading? Well, in this situation, we look at the probabilities and the distribution of those probabilities. And right now, there are a number of scenarios that could happen, and we try and work the probability of it coming through. And right now, I think the market's got a reasonable view on where we are in terms of what it's pricing.
I think you're right, Chris, and that's a hell of a setup in crude. And if there is a diplomatic approach, that Brent we're gonna back up all those green candles. So, and
we'll price that in before it actually happens. That's the thing about markets, and that's where this headline we get a headline out that says they're coming to the table, and people say, right, the probability of exports being impacted, obviously lows, and yeah, so we price it in just on headlines, and that is where we are in terms of your trading dynamic. It's a headline-driven market, and is that for you?
That it? Yep. You got to ask yourself that question. All right. Well, my last setup is going to be Ethereum, and Ethereum. We are at channel support. I'm going to point out just a couple of things here. You could argue either direction at this point. We're on channel support. You see the 50 DMA. It's that orange lower moving average. We're basically sitting on it. So break below that 50 DMA. Look out. We're going to see some downside. Now, the upside's capped by the 200 DMA, which is the red moving average. We get above that, we're going to challenge that channel top, which comes in right around 2850, I think, 2900 actually. So, there's a little bit of something for the bulls out there if we break above that moving average, that 200 DMA, but also for bears. And I do want to point out Bitcoin, I'm looking at it as a longer term Wyckoff distribution pattern. If you don't know what that is, Google it, kids. Just Google it, or maybe ChatGPT.
Isn't he part of the Trump administration?
Yeah, no, it is a Wyckoff distribution pattern. Great technical setup that I love to see when I see them. And Bitcoin's fitting that mold, which is a little bit of a risk to the crypto complex, especially if we start seeing below 100,000. That's when I'd start to worry about any bullish ideas with Ethereum. The flip side is, hey, Bitcoin's still holding above 100,000. Let's not discount that. I mean, there's something to be said about that. So I think this is a great setup. If you're bearish, you know where to turn bearish. If you're bullish, you know where to turn bullish. keep this one on your radar.
I'm thinking Wycliffe, but it's also the Wycliffe from the Fugees was I was thinking. No, I know exactly what you're talking about. Anyway, that's a great one. I do like that. Have a look at the Trump coin as well, because that's down for like 6 or 7 days in a row, and it's that looks pretty weak as well. That's one that I'd probably look at shorting if you've got the risk tolerance, because it's obviously very high beta, less liquid play. Anyway, let's go to play of the day. Anyway, enough of my rubbish gags. Let's go and have a look at one that I looked at last week, which was my play of the day, and it's doing all right. I mean, it's worked out pretty well. Caught the right side of that one, and it's just developed right now. So, because if you're looking for what's weak in global equity markets and indices, this is for me the weak link. Is it oversold? Probably getting to that point. But look, I mean, this is an ugly move, and what I love about this, Blake, is that you've got all those rallies are being contained into the short-term EMA. That tells me that you've got this. The market is de-risking and respecting that, and this is a trend, and this is a trend that I want to be involved with. We've broken through that spike low, and CTAs are taking out. People are moving out of that market. You can also play the short DAX, long S&P, because I think that's working beautifully as well at the moment. If you're into more sort of a tactical long short strategy, but look at that chart right now. I mean, I don't need to go into huge amounts of fundamentals about the companies that are missing within that market and all these factors and flows and bits and pieces. But look at that chart, Blake. What would you do? Would you be long or short? Very simple.
It's a false breakout. I'd be on the short side, and it is below the 24% retracement, the 23.6, and the 50 DMA based on my memory. So throw that on top of the put that shrimp on the bobby. There, Chris. You got it.
Did you say ship or shrimp? Did you say shrimp?
Shrimp. Ship, whatever.
Oh,
sorry, whatever.
No, one of the things I want to just say here is that, last week we talked about it. And this, for me, is the art of building positions. So I know people out there, probably not martingale. I think about it the opposite in this situation. Start off small. When the market likes it, you start seeing a trend develop. I'm adding to the short on this position here.
I like. All right. Well, that's 2 weeks in a row, Chris, and you're spot on. All right. So my play of the day is going to be the euro dollar. And this one goes out to my best friend who I've known since I was a kid. He became a grandfather. He is known as Papa Don. So all the best to my best friend and baby Banks and your family. So when I say come to Papa, hey, the euro, I told you guys earlier, ultimately, I want to be long the euro. I want the euro to pull back to the 38% retracement. I'm looking around 114.15 or so, 114.20, but also that trend line comes in right around 114. So if the euro can back itself up, I know it's about 100 pips from where we trade at currently at the time of recording, but I still think there's some dollar volatility. I think some dollar longs are going to be coming into the market. Some of the dollar shorts are going to be coming out of the market as we see some two-way price action. So I'm going to say, come to Papa, and let's come to Papa Don, my best friend, and him and his family. We're gonna get long some euros on a dip down to 114, Chris, and that would be my play of the day.
Play du jour. Well done. Thank you very much, Blake. Thank you everyone at home for following. And it's been a long show today, but obviously a lot going on. Hope for some good intel and delivering some outperformance for the portfolio as well. Anyway, thank you everyone. We'll see you back next week for more of the trade-off.